Welcome back to Mortgage Markets and More. I'm your host, Peter D'Angelo, branch manager for Rate here in Totowa, New Jersey. I hope you're all doing well and having an awesome week. I'm very excited today. This is an important update, and I actually get to deliver some good news. It's been a few weeks on these update episodes, but today is a good day, and we're going to get right into it as to why. So again, this is the summary of mortgage rates according to Mortgage News Daily as of the recording of this podcast, the Thursday morning before its release. Rates do change every day, so I want to make mention of that every episode. 30-year fixed rate mortgage across the country is currently averaging 6.81%. The 15-year fixed rate mortgage is averaging 6.15%. The 30-year jumbo is averaging 6.95%. The 30-year FHA averaging 6.18%. The 7/6 SOFR adjustable rate mortgage is averaging 6.35%. And that 5/1 SOFR adjustable rate mortgage, according to bankrate.com, that's averaging 6.02% as of this morning. Across the board, interest rates have gone down by a little bit. This is the first bit of relief we've seen in the past few weeks, actually for most of April. So coming into May right now, we've got a little bit lower interest rate environment that we get to take advantage of. Let's kind of see why that happened, and we can see our first signals in the bond market like we always look at. So as of this morning, the 10-year Treasury yield is at 4.141%. The 5-year Treasury yield is at 3.709%, and the 2-year yield is at 3.588%. This is a flattened out yield curve, more so than we've seen in quite a while. We're seeing what I would call a healthy spread now between the 2, the 5, and the 10. So you invest in the bond for 10 years, you get more yield on your money. All of those have dropped, and that 10-year bond was particularly volatile. We talked about that on past episodes, but for right now, we're looking pretty good. This is part of the reason why we're seeing the interest rates where they are, but this requires a little bit more analysis. We're going to go through some of the key data points and key headlines that have happened over the course of the past week that moved the mortgage rates in the direction that they did and moved that bond market in the direction that it did. So we did an episode this week. It will get released soon on the National Association of Realtors existing home sales data. That was for March of 2025. Too long, don't read. Give you the headline information. Home sales fell sharply in March. It went down 5.9% month over month, which is the slowest March on record since 2009. Median home sales price, on the other hand, hit a record high. So again, supply and demand. There's a bit of a mixed signal happening here because there was obviously lower sales numbers, but that median sales price still going up, showing that stalemate that's still evident in the market. Now, the job openings, labor turnover survey, the JOLTS report came out. The reason why this is important to us is because it's important to the Fed. The Fed is looking at job information, labor information, and they're looking at inflation. Well, we have two reports to talk about today that moved the interest rates. First is the JOLTS report. That came in with job openings falling to 7.192 million job openings. That is a multi-year low. As a matter of fact, I think that's the lowest that we've seen since, July of last year, July 2024. That's the last time that we saw a large reduction in the job openings labor turnover survey. We also got inflation data, the personal consumption expenditure. This one is the one that is the Fed's preferred inflation gauge. Well, the headline inflation number came in at 2.23% year over year. That's taking into account everything. That's goods, services across the board. Then the core, which removes volatile elements, those are food and energy, those prices get taken out, and that core also cooled down to 2.61% year over year. Month over month, this was a flat reading for our personal consumption expenditure. So that's showing some progress on inflation. Again, data's delayed a little bit, but still, that's showing us there's some improvement. We can't look at just one data report. We need to see trend, but that's moving in the right direction. Much better than inflation going up. Then we also got pending home sales for March, and that surged. So there was a surge in March. Even though the homes didn't sell, there was a lot of pending home sales. So where the existing home sales dropped, there's a lot that's pending sale, and that came in 6.1% up month over month. Quite a lot of pending home sales, which is the largest gain since December of 2023. So the impact is that there's renewed buyer interest as interest rates dip down a little bit. Remember, we had like a 7 to 8 week run where interest rates were making improvements before April hit. Stands to reason that was possibly a reason why people got off of the sideline, got into the game, and got under contract to purchase a home. Then we also got the ADP report. We actually have two employment-related or job-related data points. That came in showing us private payrolls grew by 62,000 jobs, which is the weakest growth since July of 2024. The impact is that this confirms that there's a labor market cooling happening right now, which could be encouraging news for interest rates. So I'm going to now call a shot real quick. This is just my opinion, but I noticed something. We've been doing this podcast for a couple of years now, so I kind of remember some things that happened back in July of 2024. It was a comparable scenario to where we find ourselves with a few distinct differences. Where it was the same, number one, we got a JOLTS report that was much lower in July of 2024. If everyone recalls, it was in July that we received, I think it was a news article that was released or a report by the Bureau of Labor and Statistics that said they actually overstated the job openings when they looked back from April 2023 to March of 2024 by almost 1 million jobs. So that meant that the data-dependent Fed that was waiting on those jobs reports was getting incorrect information, and that they actually indicated a stronger job market than there actually was. What happened after that? If you recall, July into August and then into September, we saw the lowest interest rate environment that we've seen in just about, I would say, 2 years now. Interest rates dropped tremendously, maybe going back to January of 2024. That's probably the lowest that we've seen. But we got darn close there in August and September. And that was precipitated by exactly this. It was precipitated by job openings, labor turnover survey, weak job market, cooling inflation. But what really moved the needle, and the reason why I'm bringing this up now, was that ADP report. If you recall also, there was a huge miss on the new jobs added from the ADP report in July of 2024. That huge miss is part of what triggered the Fed to cut interest rates by 50 basis points at their September meeting in 2024. Now, those are the data points that are aligning, and that makes sense. We also are seeing ourselves in a comparable bond market environment right now too. So all these things are following that script. Here are the things that are different. I would try to get through the whole episode without saying it, and I'm so sorry, but I have to say it. Tariffs. Oh, I know. I'm tired of hearing it too, but they are making an impact on everything right now. So the tariffs is the element of all of this that's still creating this uncertainty that I can't confidently say, oh, well, now let's expect lower interest rates to start coming through. What I will say is I am the most optimistic right now than I've been in the past few weeks about seeing some lower interest rates in the near term. The caveat is any headline about tariffs, anything that's going to upset the apple cart that continues to be upset, anything that's going to do that, well, that's going to change this narrative and change the script a little. But the elements are here for that. Take that with the grain of salt that I'm also giving you, possibly some cause for optimism here in the short term. Lastly, the GDP, gross domestic product. This is an indication of the health of the U.S. economy. Well, that constrained a little bit. We saw that annualized pace for GDP coming in at 0.3%, and that just shows us an indication of some weakness in the U.S. economy. Weakness in the U.S. economy, job market showing weakness, inflation cooling, really a data-dependent Fed, these are the ingredients that are kind of required for a Fed rate cut. I think my personal opinion is that May is going to be too early for anything like that because they need to see trends. But these are some good data points that we're seeing. So hopefully, if the data continues to come in aligned with this trend that it seems like is developing, let's say, then we could possibly see lower interest rates even sooner. I want to also give a quick summary. So we went through a number of different data points. So I just want to give you like the highlight reel now. So first, weak GDP, that helps interest rates to come down. Softening labor market helps interest rates to come down. Easing inflation helps interest rates to come down. The mixed real estate market news between the existing home sales decline, but the pending home sales surge, mixed bag, flat, not really having an impact. Tariff and recession concerns, well, that's actually going to push interest rates higher. So that's it. Overall, my indication on the trend here is that interest rates could be moving lower in the near term. If you have any interest in purchasing a home, this is your moment. This is your helping hand going out there. Give me a call. Reach out. My contact information's in the episode description. You can find me on socials. You can Google me, Peter D'Angelo Rate, and I come right up. Please do reach out if you've been considering. Now could be an opportunity, and I'll leave you with this. Barbara Corcoran was being interviewed, and she said something that really resonated with me. And she mentioned that essentially in times of chaos and uncertainty, that's when you have the greatest opportunity. As long as you are committed and that you understand any risks that could be involved and everything is working for you from a budget standpoint. If you can hit all those marks, take advantage of the opportunity. When those who are in fear mode and panic mode and frozen, be the one to move. Thank you so much for listening. I hope you found this helpful and useful. I am very much looking forward to continuing to provide you with updates on this on a weekly basis as it develops. This could be an interesting next couple weeks, so definitely tune in. If you know anybody who would benefit from this information, please like, share the show, subscribe. Some more information next week. I'll be delivering some new market updates. And guys, we are on our way to our first round of interviews. Yes, these will be specialty episodes that will drop, but I'm very excited to start doing some interviews, talking to industry professionals, and then talking to anyone. My goal and intention for these interviews is to talk to amazing professionals here in our local community in northern New Jersey, business owners, professionals, experts in industry, so that I can provide you with some more insights other than just me, because I know that I would also benefit from hearing from other experts too. I hope you all have a great rest of your week and have a great weekend. Take good care.